First, the Bernie Madoff Ponzi scheme. This monumental fraud was orchestrated by Bernard L. Madoff, the founder of Bernard L. Madoff Investment Securities, LLC, primarily out of New York City, USA, though its reach extended globally to countless investors. Madoff was a seemingly unimpeachable figure on Wall Street, a former NASDAQ chairman and a noted philanthropist, which lent immense credibility to his exclusive investment firm. For decades, Madoff promised investors consistently high and steady returns, even during periods of market volatility. His deception involved using funds from new investors to pay returns to earlier investors, the classic hallmark of a Ponzi scheme. He meticulously fabricated account statements, trading confirmations, and other financial documents to create a convincing illusion of legitimate and successful investment activity. The scheme's collapse in 2008, triggered by a wave of withdrawal requests during the financial crisis, exposed an estimated $65 billion in fictitious paper wealth and billions in actual cash losses, shattering trust and impacting thousands worldwide. Second, the Enron scandal. This colossal accounting fraud was perpetrated by executives at Enron Corporation, notably CEO Jeffrey Skilling, CFO Andrew Fastow, and former chairman Kenneth Lay, operating from their headquarters in Houston, Texas, USA. Enron, once hailed as a revolutionary and highly innovative energy trading company, was in reality concealing massive debts and inflating its earnings. Their tactics included aggressively using mark-to-market accounting to prematurely book potential future profits from long-term contracts, even if these profits were speculative or never materialized. Additionally, they established numerous special-purpose entities, SPEs, which were off-balance sheet vehicles used to hide troubled assets and liabilities, effectively making the company appear financially much stronger than it was. Many of these SPEs were, controversially, controlled by Enron executives themselves, creating severe conflicts of interest. The unraveling of this deception led to Enron's spectacular bankruptcy in 2001, wiping out thousands of jobs and billions in shareholder value, and ultimately led to the dissolution of its auditing firm, Arthur Andersen. Third, the WorldCom scandal. How did one of America's fastest-growing telecommunications giants become the architect of an $11 billion accounting fraud? This was the tragic story of WorldCom, carried out by its executives, primarily CEO Bernie Evers and his senior accounting personnel, from their base in Clinton, Mississippi, USA. WorldCom had rapidly expanded through aggressive acquisitions, becoming a significant player in the telecom industry. The fraud involved improperly classifying billions of dollars in operating expenses as capital expenditures, which artificially inflated the company's assets and made its profits appear substantially higher than they were. They also utilized fraudulent accounting entries to boost revenues, all in an effort to meet Wall Street's expectations and maintain the illusion of robust growth and profitability. The revelation of this massive deception led to WorldCom's bankruptcy in 2002, then the largest in U.S. history, causing immense disruption to thousands of employees and investors. Fourth, Charles Ponzi's postal coupon scheme. Before there was Madoff, there was Ponzi, the man whose audacious scheme lent its name to an entire category of financial fraud. The original Ponzi scheme was devised and executed by Charles Ponzi himself, primarily in Boston, Massachusetts, USA, in the early 1920s. Ponzi, an Italian immigrant, arrived in the U.S. with little capital but a persuasive personality and grand ambitions. He promised investors extraordinarily high returns, sometimes as much as 50% in 45 days, by claiming to profit from arbitrage opportunities in international postal reply coupons, buying them cheaply abroad and redeeming them for a higher value in the U.S. However, in reality, no such legitimate arbitrage operations were conducted on a scale to generate these returns. Ponzi simply paid off initial investors with money continuously collected from new investors, relying on an ever-increasing inflow of fresh capital to sustain the illusion of profitability. The scheme eventually collapsed, leaving thousands of investors financially ruined and contributing to the failure of several banks. Fifth, the Theranos fraud. In Silicon Valley, a place synonymous with innovation, A dream turned into a nightmare when the promised revolution in blood testing proved to be a multi-billion-dollar fabrication. This high-profile deception was spearheaded by Elizabeth Holmes, the charismatic founder and CEO of Theranos, and her chief operating officer, COO, Ramesh Sunny Balwani, from their base in Palo Alto, California. Holmes, a Stanford dropout, captivated investors with the promise of a proprietary device capable of running hundreds of blood tests from a single drop, leading to a valuation of $9 billion. However, the core technology, Edison, never functioned as claimed. Holmes and Balwani systematically misled investors, partners, and even patients by misrepresenting the capabilities and accuracy of their devices. They often resorted to using traditional commercially available lab equipment for most tests while falsely asserting the superiority of their own technology. And they doctored validation reports to deceive investors. The fraud was ultimately exposed by investigative journalism, leading to the company's downfall and the criminal conviction of both Holmes and Balwani for defrauding investors. Sixth, the Wirecard scandal. A rising star in the German tech scene, once hailed as a beacon of innovation, suddenly imploded when billions of euros simply vanished from its balance sheet. This significant financial scandal involved executives at Wirecard AG, notably former CEO Markus Braun and COO Jan Marsalek, operating from their headquarters in Aschheim, Germany, though the alleged financial impropriety involved various international subsidiaries and trust accounts. Wirecard, a rapidly ascending fintech company and payment processor, was once lauded as a shining example of German technological prowess and even included in the prestigious DAX 30 index. The company was embroiled in a massive accounting fraud where 1.9 billion euros, approximately $2.1 billion, in cash balances reported on its balance sheet were found to be missing and almost certainly never existed. The company's financial statements had been falsified for years, with a substantial portion of its reported revenue and profits being fictitious. The supposedly missing cash was said to be held in trust accounts in the Philippines, but the alleged trustee banks denied any knowledge of these funds. The unraveling of this fraud led to Wirecard's insolvency, significantly damaging Germany's financial reputation and sparking calls for stricter regulatory oversight of fintech companies.